Also, we just have not seen the inflows from registered investment advisors and institutions that we would expect. And that's actually, if you step back and look at it, that's actually not that surprising. So you still have people out there who don't have you have investment advisors out there who don't have the capability yet. And then you still have the Vanguards and the UBSs and the Merrills who are pushing against it as hard as they can. And so the on-ramps are not there yet. It's going to be slow. It's going to be more like a trickle until it turns into a flow. And right now it's a trickle.
On Monday, Bitcoin's price fell below $40,000, a level it had maintained for almost 50 days since hitting that threshold on December 5th, 2023. According to data from CoinMarketCap, the leading crypto asset lost around 5% of its price in 24 hours and around 10% in the past week leading up to Monday. The leading crypto asset tumbled down to a low of $38,500, down by over 20% from the January 10th peak of $49,000 per coin. While there has been a lot of speculation about the reasons for the recent price declines, all fingers seem to be pointing at GBTC. According to Alex Thorne, head of research at Galaxy, the GBTC outflows have reached new highs, way more than the other Bitcoin ETFs can offset. On Monday, Alex commented on a post by Bloomberg analyst Eric Balchunas about the increasing GBTC gouge. His comment reads, "Based on my tagging, I'm seeing between $623.7 million and $784.7 million sent this morning, which is the largest settlement between Grayscale and Coinbase Prime that I've seen so far." Alex also responded to posts from other accounts alleging that the transfer was actually around $900 million. He noted that there is a bit of discrepancy about addresses belonging to Coinbase or not, but an image from Arkham Intelligence shows 15,818.461 Bitcoin outflows from GBTC, valued at $640 million at the time of writing the post, and $658 million when the transfers were made at 4 p.m. Eastern Time on Friday. According to Eric, a senior Bloomberg ETF analyst, anything above $500 million would still be too much for the newborn 9 ETFs to take on. Eric also expects the GBTC puking to continue and possibly cause further declines in Bitcoin's price. James Lavish, a renowned macro analyst and former hedge fund manager, says it's important to expect further downsides as the GBTC bloodbath continues. However, he points out that there are other important fundamentals, including the upcoming halving event, that could change everything almost overnight. We will now bring you clips from Lavish's latest discussion with Scott Melker. As we do, please take a little time to like this video, share it with others, and subscribe to the channel for more interesting and insightful analysis. Thanks, and enjoy the video.
I don't think it stops in the near term. I think it's just going to continue to bleed out because it's got a 1.5% fee on it versus 0.25% on any other, right? So the margin there on fee is just so great that I think it's almost impossible for you to look at that and think that it's a good value, even though they've been in the space. Running an ETF, I mean, ask Dave, running an ETF is not that difficult. You have to have some trading acumen and be able to make the markets in order to be efficient and match the underlying performance of the asset. But that's not that difficult, especially with all the programs and machines we have now. It's not something that sets them apart in my mind. So that argument from them is they're going to continue to lose that argument every single day that they keep their rates at 1.5%. So no, I don't think it's just gonna stop overnight. It will ease at some point, and you'll just run into these the core holders that don't care about the fees, and they think 1.5%, who cares? This is an asset that's going to go up hundreds of percents, so who cares? But we're not there yet, in my opinion. Also, we just have not seen the inflows from registered investment advisors and institutions that we would expect. And that's actually, if you step back and look at it, that's actually not that surprising. It's bullish and it's not that surprising because it takes a while, not just for all of these firms to get their pipes in place. They have to. When we went, just for information, when we went to buy the spot ETF for a volatility position that we were putting on for my hedge fund, we had to instruct our prime broker to go and add the QSIPs to their systems in order to settle the trade. That was on the morning of these things opening, and that's not atypical. So you still have people out there who don't have you have investment advisors out there who don't have the capability yet. And then you still have the Vanguards and the UBSs and the Merrills who are pushing against it as hard as they can. And so the on-ramps are not there yet. It's going to be slow. It's going to be more like a trickle until it turns into a flow. And right now it's a trickle, and it will become a flow. The question is, and I think that Mike brings up a great point, is do we hit the economic skids before it turns into a flow? Because we're still in a slow-moving, event-driven situation with Bitcoin and the ETFs. It's still playing out kind of in slow motion every single day with GBTC and more managers getting access to it.
Lavish describes himself as a reformed hedge fund manager who left the traditional financial sector because of the immense rot within the system. For years, Lavish has warned about an impending collapse of the entire global monetary system. However, his warnings have become more urgent and gloomy in recent months, especially since the U.S. national debt hit a high of $33 trillion in September and $34 trillion less than 4 months later. Lavish warns that the United States is caught in a vicious cycle of money printing, currency debasement, economic challenges, and more money printing and further currency debasement. Lavish believes that the United States has successfully buried itself under its massive load of debts, with only one viable solution: to sink deeper in debt as expenses continue to increase and revenue takes a nosedive. During his discussion with Melker, the reformed hedge fund manager shares a very gloomy outlook on the U.S. economy, stating that we could already be in recession. Here are more clips from the discussion.
This is inflationary, the deficit spending. And so but where does it stand? And you're seeing the interest expense, but we added $2.6 trillion of federal debt last year. And now we're running at $2 trillion of annual deficit, right? So if we're spending $6.4 trillion, our revenues are about 4.4. The GDP is not keeping up. And so, that's our tax base. So the problem is if Mike is right, and my suspicion is right, and we run into a recessionary period here pretty quickly in this year, then typically your entitlement spending rises by about 8 to 12%. And then because of unemployment, et cetera. And then your revenue decreases by a like amount. So just using 10% on kind of an average for both of those, you're talking about your spending increasing to over 7 trillion, and then your revenues dropping to under 4 trillion, giving you a deficit of over 3 trillion. And that's so we're running to this is the most important part about what you're talking about, Scott, is that we're running $2 trillion deficits and we're not even in a recession. Like, this is just, it's absolute madness. It's lunacy. So if and when we do hit a recession, that's going to go up by 50%. And what do you think they're going to do? You think they're just going to allow the GDP to drop off a cliff? Of course they're not. The playbook does not allow for it. There's not a page for that in the playbook. The page goes, it goes, go to page 99, which is print again. Here's something interesting. So just look at I wrote about the Michigan consumer sentiment, Michigan numbers, right? The consumer numbers. And so what's really interesting is that we hit levels over the past year and a half that would be consistent with a recession, right? So if you see in the recession, we hit levels that's really consistent with recessions, but we didn't have one. Why? Why did we not have one? Because of massive deficit spending that covered it up. It just papered right over it. So people are feeling terrible. Prices are high. They can't afford things. Yet GDP is running. Wow, how is that possible? Well, because
pushing on a string.
You're pushing on a string. Yeah, you're pushing on a string. So, yeah, consumer sentiment is coming back. But I will, and Dave and Mike will agree with me every single time. Look at where consumer sentiment is right before a recession. It's always right at the highest level of that period, and then it drops off a cliff. I mean, so when everybody's feeling great, that's the time to get a little bit itchy and worried. And so we're not quite there, but there's something that just doesn't add up here. And I'm going to contend that it is the deficit spending, severe deficit spending in a non-recessionary period that kind of papered over the recession and made it look like everything's rosy. And so when you have politicians in the White House up there, claiming, and professional economists and PhD economists up there claiming that people are lying, their life is good, it doesn't make sense, everything's great, the economy's running along, Bidenomics, it's not true.
Meanwhile, Eric Balchunas believes Bitcoin investors still have a lot to be excited about despite the ongoing correction. In one of his latest posts on X, the senior Bloomberg analyst compares Bitcoin's year-over-year performance to that of traditional asset classes. The post reads, "Even with GBTC, ETFs are still net buyers of $1 billion since the dumping began, so it would be worse without them. You need to look to your crypto brethren for the culprits. Also, even post-dumping Bitcoin is up 75% in the past 12 months. That's demolishing all equities and bonds. It's nearly double the QQQ, which just had its best year since 1999. How spoiled can you be that you are living in angst right now? You will be in a permanent state of misery if you don't get perspective." Eric's outburst shows he still has a lot to learn about the cryptocurrency industry. However, there are some truths to his statement. The ETFs just started trading, the halving is still a couple of months away, and we are generally still early into the bull market. Hopefully, as the ETF trickle grows into a steady flow, prices will stabilize and we will be off to $50,000 and above. What are your thoughts on the video? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.